An ugly quarter from Disney. Earnings missed estimates on the top and bottom lines. The company warned that it expects core Disney Plus subscriber growth to be lower in the first quarter, while also striking cautious tone on the economy on the earnings call last night. Brad, this was somewhat of a shocking quarter from Disney. 3 months ago, we were here talking about a comeback quarter from Disney. Here is Disney today, missing on the top and bottom lines, looking at a good note from the folks over at Guggenheim, really saying this quarter smacks down any bull case on the stock.
Yeah, and you look at some of the segments where they ultimately saw a decline. Segment revenues declined in the media and entertainment and distribution segment. That was down 3% year over year. You also saw a 91% decline in the operating income for that segment. So that's significantly being latched onto by the street, at least here today, as we're taking a look at shares pre-market. And over the past 3 months, even that decline is going to stand out. Considering Disney is a household name, some might even call it one of those best consumer indicators because it has everything from entertainment content to the little purchases of those little plush dolls that you might get as toys for kids. Everybody loves those. You've had one at one point in your life.
I have one now, Brad.
Right.
I have one now.
And the parks and resorts experiences. So everything from the experience economy to the entertainment economy down into the individual items that we purchase in our households as well.
Yeah, and we talked about yesterday with Ali Canal, who covers Disney extensively for us, that this stock has historically been trading, I'll say, past 2 years off of the direct-to-consumer numbers for streaming. I would argue this is the quarter that now, going forward, the stock may trade off of what's happening in the theme park business. And I bring this up. Now, Disney stopped short, of course, of saying on its earnings call last night that they predict a recession. But to me, this is a Disney now starting to tighten its belt on costs ahead of an economic slowdown next year. Now, that parks business has been the key driver of Disney over the past year. If that is going to slow at the same time where losses are still happening on Disney Plus and their direct-to-consumer offerings, that's a huge negative for the stock, huge negative for the company's profits, too.
Just briefly on that ad-supported subscription offering, this is important to hit on because this is going to be their opportunity to bring advertisers that opportunity to add on to their marketing spends, and in a capacity where we know ad budgets right now are shrinking. But if you figure out the best way to, at the top of the funnel, at least generate awareness, and perhaps that is increasingly through some of these streaming platforms. Disney Plus is essentially coming just after Netflix has been able to launch theirs just recently, too. And so they talked about this on the call last night, and that is going to be significant. They're saying that the launch brings fans a slate of subscription plans across Disney Plus, Hulu, ESPN Plus, and this Disney bundle with a better kind of option for some of the tiers that they could opt into before.
Real quickly, I'm getting some pushback from our team on me viewing the parks as the most important component to the Disney story. I will say this. It is the parks business that allows Disney to invest aggressively in that direct-to-consumer business. If that parks business slows down, they will not be able to raise prices as aggressively as they have been, and perhaps that pulls them back on investing as aggressively as they have been in content on direct-to-consumer, and then maybe subscriber growth slows. Here, that's how we're connecting all in real time. That's what we do. Sorry, team. Thank you.
Right. So to put a button on that, it's the margins from parks and resorts that go back into the content side and the streaming platform side, which is the core growth metric that many investors have been looking at for years now.